Good morning and welcome to our Ashworth Wealth Weekly Market Update. My name is Scott Thomas. This week, I wanted to go back and I wanted to talk about the market update I did here a couple of weeks ago and maybe give it a little bit more context. I wanted to talk about the revision that we had here about a month ago in our jobs report. And they revised the new job reports or the new job numbers for this last year down about 820,000 jobs. The week that came out, the markets actually dropped. I think the following day it was down about 1,000 points at one point. The markets have come back since that point, but I did want to address that, and I want to look at that maybe in a little bit broader context. I had a number of questions about this after the last presentation that I did. So I want to read a couple of things, then I want to, like normal, I want to review kind of where inflation is at, where interest rates are at, what the Fed is doing, and what we think is coming up. But I just wanted to read part of an article that addresses this very situation. It says the latest exercise revealed the job growth was overestimated by 818,000 jobs between April 2023 and March 2024. While this downward revision might seem alarming, and I think the markets did act alarmed at this report, it's crucial to consider the broader context. The economy still added around 2.1 million jobs during that period, averaging about $174,000 a month. So even though the numbers were revised down, we still added about 2.1 million. So it wasn't quite as good as what we thought it was initially, but it's still not a bad number. I want to read one more thing here and then go through a couple other numbers. The recent rise in unemployment rate, the rate is now at 4.3%, is due more to people entering the labor force, not from layoffs. Employment continues to expand, albeit at a slower pace, indicating that the labor market is normalizing rather than weakening. Also, a couple of weeks ago, we also went over what companies are reporting as they're doing their quarterly earnings reports. And very few companies, in fact, there was no rise at all in companies reporting that they're planning to lay people off. So the moral of the story here is the economy has continued to be fairly resilient, and we expect that to continue. A couple other stats here. Last week, the second quarter GDP was revised up to 3%, which is good. And this week's job report will be critical. We're getting a jobs report again this month. That will be critical in how the Fed looks to the future and whether they will have gradual rate cuts as we expect that they will later in the fall. So we expect there will be at least one. Some economists think as many as 4 rate cuts by the end of the year. I don't think it will be that many. I think if we get 1 or 2, that's probably in line with the way things look right now. But just to give you an idea, the Fed meets again September 17th and 18th. I would expect, if I were a betting man, that we will have some type of a rate cut, a quarter basis point rate cut sometime in September. I don't think there's going to be a lot of news that comes out between now and then. And the way that the Fed has talked, the way that Chairman Powell has talked, I think that's probably going to happen in September. So we're going to watch that on the 17th and 18th when the Fed meets again. Another bit of good news is inflation. When you look at from July of 23 to July of 24, was 2.9%. We are not down to the 2% goal that the Fed has, but it's the lowest inflation number that we've had for a year, rolling 12, since 2021. So things are definitely moving in the right direction. And as long as everything continues to look the way it is, I think that the Fed is going to go ahead and start lowering interest rates. Okay, one other thing that I wanted to look at here is it's always interesting to me to look at what mortgage rates are. These are interest rates that really affect people, especially those that are buying houses right now. The average mortgage rate, and again, sometimes in Utah or in different areas, it's a little bit low, but the national average as of yesterday was 6.42%. So interest rates for 30-year mortgages have edged down over the last couple of months. So what do we expect in the near future? Well, all eyes are on the Fed again, September 17th and 18th, and we should be getting some news on that. It's going to be very interesting, and we'll continue to update what companies are saying as they're reporting their earnings, whether they're at earnings, above earnings, and what their expectations are, whether they're planning on layoffs or expansion of equipment, those kinds of things. We'll continue to monitor that. The other thing is with the election, obviously that's going to be a very interesting thing to watch over the next 4 or 5 months. But we continue to expect more of what we've had over the last few months. We're going to have some volatility, but the economy has continued to be quite resilient. So again, we appreciate you joining us each week for these updates. Like I've said before, we've had some good feedback on this. We've had some good questions. Please feel free to share this with friends and family. If you have any specific questions, please email myself or Robbie or Todd, and we'll get to those as fast as we can. Again, thank you. Have a good week, and we'll see you later.